What if I told you that the most powerful financial institution on the planet just made a move that could make traditional banks completely irrelevant to crypto? The Federal Reserve, the institution that controls the backbone of every dollar transaction in the world, wants to give crypto companies direct access to its payment systems. No bank license needed. And the banks, they're absolutely terrified. Welcome to the AIA Uncut podcast, and let's dive in.
It really does sound like the setup for a financial thriller, doesn't it? But this is very real. We are currently watching a massive battle over the actual literal plumbing of the U.S. economy.
Yeah, the plumbing, which I know usually sounds incredibly boring.
Right.
We really don't think about the pipes until the sink backs up. You just swipe your debit card, the little terminal beeps, and you walk away with your coffee. You don't see the massive, complex machinery moving underneath.
Exactly. But right now, there is this huge regulatory war happening over who actually gets to own those pipes.
It's basically the old guard, which is the traditional banks going head-to-head with the new guard, the fintech and crypto companies.
And the referee in the middle of all this is the Federal Reserve. The stakes here aren't just about who gets to collect a tiny fee on your latte. This is a fundamental shift in who holds the keys to the central bank.
Which is our mission for today's deep dive. We are going to unpack the Fed's brand new payment account proposal.
Or, as everyone in the industry is calling them right now, the skinny accounts.
Skinny accounts.
Yeah,
it sounds like a diet plan for your wallet. But we need to figure out what this actually means, why the banks are lobbying aggressively to stop it, and ironically, why the crypto firms are complaining that it doesn't go far enough.
It's a fascinating dynamic.
So set this scene for us. What is the actual news here that kicked this all off?
Well, it stems from a proposal that was pushed by Fed Governor Christopher Waller back in late 2025. He basically proposed an entirely new type of account specifically for non-bank institutions.
Meaning fintechs and crypto firms.
Right. The goal is to give them direct access to the Fed's payment rails. Specifically, we're talking about FedWire and FedNow.
Okay, let's pause right there and unpack direct access. Because I think a lot of people listening, myself included, probably assume that if you are a massive billion-dollar financial company like a Stripe or a Coinbase, you can just move money on your own.
You would think so.
You don't need permission to send a wire, right?
Well, no. That is the illusion of modern finance. Think of the Federal Reserve's payment system, especially FedWire, as the interstate highway system for money.
Oy.
This infrastructure moves over $1 quadrillion annually. It is the absolute backbone of the global economy. But right now, to drive your own car on that highway, you need a very specific license.
Banking license.
Exactly. And currently, only about 9,200 traditional regulated banks actually have those keys.
So if I'm a massive fintech company, I can't just drive my own car onto the highway.
No, you are essentially a hitchhiker. You have to borrow the bank's car. You have to partner with a traditional bank, put your reserves in their vault, and basically ask them nicely to move the money for you.
And I'm guessing they don't do that for free.
Oh, absolutely not. They charge you a toll for the privilege. And perhaps more importantly, you're subject to their rules. If the bank decides that crypto is suddenly too risky, or if regulators lean on them, they can just kick you out of the car.
Which we actually saw happen recently. The industry was calling it Operation Choke Point 2.0, where crypto firms were suddenly getting debanked overnight.
Precisely. That is textbook counterparty risk. You are relying entirely on a third party for your very survival. So this skinny account proposal is the Fed basically saying, okay, fintechs, you don't need to hitchhike anymore. Here are the keys to your own car.
But there is a catch. It's a skinny car.
Very skinny. It's a car with a governor on the engine, practically no gas in the tank, and a GPS that reports every single turn you make. It is a prototype.
Built to minimize risk.
Right. Built to protect the broader financial system. The restrictions are severe, which is why they earned that nickname.
Let's run through those restrictions so we really get the nuts and bolts. If I'm a fintech CEO and I get one of these accounts, what am I giving up?
First thing, unlike traditional banks, these accounts earn 0% interest on reserves. If Bank of America parks $1 billion at the Fed pays them interest on that cash. Skinny accounts get 0.
Okay, so it's a storage unit, not a savings account.
Correct. Second, and this is a big one, is no credit. Traditional banks get access to the discount window, which is for emergency loans. They also get intraday credit.
Intraday credit. Let's translate that out of banking jargon.
Sure. So in the normal flow of a business day, payments are constantly flying in and out. A bank might need to send out $100 million at 10 in the morning, But the incoming 100 million they are expecting doesn't arrive until 2 in the afternoon.
So they're short for a few hours.
Right. And the Fed lets them briefly go negative. They can overdraft during the day to smooth out those operations.
But the skinny accounts don't get that grace period.
Not at all. It is a strict hard stop. The transaction has to be 100% pre-funded. If a crypto firm tries to send $100 million and they only have 99,999,000 in the account, the Fed's computer automatically rejects the entire transaction.
Over 1 cent.
Down to the penny. No wiggle room whatsoever.
That sounds incredibly stressful from a technical side. If you are processing thousands of payments a second, ensuring you never overdraft by a single penny requires some serious real-time engineering.
It is a massive technical lift for both the companies and the Fed. But there is one more restriction that really has the industry up in arms: a cap on balances.
Right, I saw this in the proposal.
Balances are capped at the lesser of $500 million or 10% of the institution's total assets.
$500 million. Now, to you listening, that probably sounds like an astronomical amount of money. But in the context of the global financial system, is that really skinny?
It is incredibly skinny. It's basically a rounding error for the global economy. For a major player, 500 million is nothing. And we'll get into why that's a massive deal breaker for the crypto giants in a minute.
Yeah, we definitely need to circle back to that cap.
But first, we should look at the reaction.
Yeah.
Because even with these incredibly tight restrictions, the zero interest, the hard stop, the cap, the traditional banks are still furious.
The old guard is fighting back. You mentioned major banking associations earlier, the ABA, the Bank Policy Institute, the Financial Services Forum. They are lobbying aggressively to either kill this or stall it. Why? If the accounts are so crippled, why the terror?
It really comes down to revenue and territory. First, the revenue. Think back to that hitchhiking analogy. Banks charge massive fees to act as the middleman for these fintechs.
The middleman tax.
Exactly. If a crypto firm can suddenly go direct to the Fed, that entire revenue stream just vanishes overnight. It's a classic case of disintermediation.
They're getting cut out of the loop. But they can't exactly go to regulators and just complain about losing your fees, right? They need a better public argument.
They do, and their main argument is safety. They point out, and quite accurately, that traditional banks are heavily regulated. They have deposit insurance, strict capital requirements, and literal armies of compliance officers looking for money laundering.
So their argument is that letting lightly regulated tech companies into the Fed system introduces too much risk.
Right. Specifically, they fear something called nesting.
Nesting, like the Russian doll.
Exactly like Russian dolls. Imagine a fintech gets a Fed account. Then that fintech turns around and lets its own customers, who might be smaller, much riskier foreign crypto firms, use that account to move money.
So the bad actors sneak in through the back door.
Exactly. The banks worry this obscures the money trail and lets terrorists or money launderers bypass the strict checks that banks are legally required to do.
That honestly sounds like a valid concern. If you open the VIP door, you need to know who the doorman is letting in.
It is a valid concern. But there's a deeper economic fear, too. The Bank Policy Institute called it the $6 trillion scare.
$6 trillion. Okay, walk us through that number.
The fear is that stablecoins, which are digital dollars living on blockchains, could become so widely used that people just stop keeping money in traditional savings accounts entirely.
A massive deposit drain.
Right. If you can hold a digital dollar on your phone that moves instantly, why do you need a savings account that pays 0.01% and takes 3 business days to clear a transfer?
So the banks are estimating that up to $6 trillion could migrate from bank deposits into digital wallets.
Yes, and here is why that matters to everyone listening. Banks use those everyday deposits to fund loans. They use your savings account to write mortgages and small business loans.
So if the deposits evaporate, then the money for loans dries up.
Or at the very least, it gets significantly more expensive to borrow. The banking lobby argues this could destabilize the entire lending economy.
It's a fascinating tension. On one side, you have this push for digital innovation and speed. On the other, you have the traditional machinery that funds housing and local businesses.
It's exactly the tension Governor Waller is trying to advocate. He's trying to find a middle lane between these two extremes.
But let's flip to the other extreme. You would assume the crypto companies are throwing a massive party over this, right? They finally get their own keys.
You would think so, but they are actually incredibly frustrated.
Really? Even companies like Coinbase and Circle?
Especially them. Some industry leaders even called the proposal dead on arrival.
Because of that $500 million cap we talked about.
Largely because of the cap, yes. Take a company like Circle. They issue the USDC stablecoin. They have tens of billions of dollars in circulation. A $500 million cap on their Fed account is completely useless to them.
It's like trying to fill an Olympic pool with a thimble.
Exactly. They literally cannot run their daily operations on a limit that low.
So for the major players, the skinny account is just too skinny.
Way too skinny. And there is another huge piece missing from the proposal. It includes access to FedWire and FedNow, but it explicitly excludes FedACH.
The automated clearinghouse. That's the network that handles the boring stuff, right? Direct deposit payroll paying the electric bill.
Right. It's the workhorse of the American payment system. It handles almost all the high-volume, low-value payments. Excluding FedACH is a massive blow.
So they get the keys to the sports car for the interstate, but they aren't allowed to drive on local roads.
Good analogy. A company like Wines, the international transfer company, pointed out that without ACH access, they would still have to rely on expensive partner banks for the vast majority of their customer transactions.
So they're still hitchhiking.
Exactly. The problem is only half solved, and the crypto industry is quick to point out that this puts the U.S. at a severe global disadvantage.
Because other countries are moving faster.
Much faster. The UK, Brazil, and India already allow non-banks to access their central bank rails. The industry argument is simple. If the U.S. stalls with these tiny thimble accounts, the real financial innovation is just going to pack up and move offshore.
Which perfectly brings us to the political context of all this.
Yeah.
Because we are in 2026, and the legal landscape has shifted dramatically over the past year.
It really has. We cannot talk about this without talking about the Genius Act.
Right. So for everyone listening, just to be incredibly clear, we are going to talk about a piece of legislation signed by President Trump in July of 2025. We are not taking any political sides here.
Absolutely not. We are just unpacking the actual text of the law and how it impacts the financial rails.
Exactly. Just the facts of the framework. So what does the Genius Act actually do?
It essentially created the first real federal framework for stablecoins. It legitimized them, but with strict guardrails. Stablecoin issuers are now required to hold 100% reserves, either in pure cash or very short-term treasuries.
And they can't pay interest to the token holders, right?
Correct. No interest. But crucially, if the stablecoin company goes bankrupt, the people holding the tokens get super priority status in bankruptcy.
Meaning they get paid back first before the corporate creditors.
Exactly. Now connect that new law back to the skinny accounts. Circle and other issuers have gone on record stating that having direct Federal Reserve accounts is the absolutely necessary first step to fulfilling the vision of the Genius Act.
Because if the law mandates that you hold 100% cash reserves safely,
the safest place on earth to hold cash is the Federal Reserve.
not a commercial bank that might fail.
Right. We all saw what happened with Silicon Valley Bank. The industry views Fed accounts as the missing puzzle piece. If you force companies to hold full reserves but deny them a safe central bank account to put them in a new plant, you create a dangerous paradox.
And there's also the broader digital push from the administration. The mandate to end all federal paper checks by September of 2025.
Yes. The government is forcing a transition to a fully digital payment infrastructure. The Fed's skinny account proposal is basically the technical groundwork to support that policy mandate.
So let's bring this all down to the listener. The everyday person who isn't running a billion-dollar stablecoin operation. Why should you care if a crypto firm gets a Fed account? What does this actually change for the average user?
It all comes back to speed and cost. If this works and that middleman tax disappears, moving money becomes frictionless. Sending funds internationally to family or paying an overseas vendor could suddenly become instant and effectively free.
That is the dream of crypto.
Yeah.
Instant, cheap settlement.
Yes. But there is a very important warning label here. These skinny accounts do not come with FDIC insurance.
Okay, that's huge. Because if I have my money in a normal bank and the bank collapses, the government guarantees my deposits up to $250,000.
Exactly. You are made whole. But if you hold digital dollars in a wallet managed by a fintech using a skinny account and that fintech goes under, there is no FDIC safety net.
Now, the Genius Act gives you priority in bankruptcy court, but that isn't the same as the government just depositing a check in your account the next morning.
It's entirely different. It's a fundamental trade-off. You gain access to faster, cheaper money that moves 24/7, but you sacrifice that ironclad government insurance.
But you also gain the innovation side, the programmable money.
Right. That is the real frontier. Imagine payments that execute automatically based on code without ever needing a bank branch to be open.
Like smart contracts?
Exactly. A contract that says, if a shipping container arrives at port X, automatically release funds Y immediately. No clearinghouses, no waiting 3 days. That is what direct access enables.
So where exactly are we on the timeline? What is the roadmap for this actually happening?
Right now, the Fed is reviewing 44 very heated comment letters. The public comment period just closed in February 2026.
And there's some internal division at the Fed too, right?
Yes. Fed Governor Michael Barr actually dissented. He voted against moving the proposal forward, specifically citing those money laundering and nesting concerns we talked about earlier.
So it is absolutely not a done deal yet.
Not at all. But the expected timeline right now is that the Fed will issue final rules in Q2 or Q3 of this year. And they are targeting an operational launch by Q4 2026.
Q4 of this year. That is light speed for a government agency.
It is incredibly fast. And remember, the technical challenge is monumental. The Fed has to build the software to enforce that hard stop on overdrafts in real time, millisecond by millisecond.
Because if the code fails and a massive overdraft slips through from a fintech company with zero actual assets, the American taxpayer is left holding the bag.
Exactly. They have to get the engineering flawless on day one.
All right, let's zoom out and summarize this deep dive. We have the Federal Reserve slowly cracking open a door to the core financial system.
We have the traditional banks trying with all their might to slam that door shut to protect their fees and systemic safety.
And we have the crypto and fintech firms complaining that the door is just way too small for them to squeeze through anyway.
That is the perfect summary. We are watching the very definition of banking change in real time. We are transitioning from an old system based on who you know and traditional relationships to a new system based purely on what you have, your verified assets and your code.
It is a massive pivot point in financial history. And I want to leave everyone listening with a final thought to mull over.
Go for it.
If tech companies can soon hold your money legally, keeping 100% of it safe in a central bank vault, and they can move that money instantly for free using code.
Unlike traditional banks that lend your money out.
Right. Do we actually need traditional banks for everyday payments anymore? Or are banks about to become nothing more than specialized storage units for long-term loans? It completely changes how we think about the future of our wallets. Thank you so much for joining us on this deep dive into the financial rails.
Thanks for having me.
We will catch you on the next one.